Hi, so today we're doing a deep dive on the CFA topic of duration versus convexity within the fixed income portion of the curriculum. These deep dive videos are intended to address specific topics that are likely to be tested on the CFA exam and the ones that we've seen candidates particularly struggle with in the past. So here we'll look at a common missed question that we've seen in the past, and then we'll go into more specifics on the concept of duration and convexity within fixed income portfolios. So with this question, we'll look at how do you use duration and convexity to estimate bond price changes when rates shift, and why does duration alone underestimate price gains or losses? So we'll look at some examples in this presentation and then dive in a little bit more to each one of these concepts and their applications. But first, let's take a look at why this topic in particular. Well, the fixed income weighting on level 1 is 10 to 12%, which is fairly meaty. And furthermore, there are elements within the fixed income part of the curriculum that are contained within other parts of the CFA curriculum as well, such as portfolio management. The error rate for this part of the curriculum is a little over 40%. As a general rule of thumb, candidates should aim to achieve a score of greater than 70% on the CFA exam. The CFA board has not published the exact percentage required to pass in any given year, but as a general rule of thumb, if you achieve a greater than 70% passing rate on the exam, that should be sufficient in any given year. Of course, hopefully with a margin of error there as well to ensure that you comfortably pass on exam day. Some of the common pitfalls are treating duration as a linear concept and ignoring the second derivative of bond pricing, or convexity, when thinking through bond price changes for changing rates and different types of bonds, using modified versus Macaulay duration, or misinterpreting or erroneously thinking through the relationship between bond prices and interest rates, as well as the impact directionally of convexity for different types of bonds. Why is this a tough concept? Well, there's a number of formulas within this part of the curriculum that apply to both duration and convexity. And while it's important to know those formulas, I think what candidates often miss are the larger concepts on bond portfolio management that are inferred from duration and convexity. And by missing the analytical framework of these concepts, that can often result in misapplications and misinterpretations of the relationship between parallel and non-parallel interest rate shifts and the implications for bond price fluctuations depending on how rates are moving. What we're hoping to achieve through this deep dive is to give a crisp and clear understanding of what duration is, what convexity is, and how those relationships relate to bond price moves given interest rate changes, and how convexity in particular has implications for the asymmetry of upside or downside price fluctuations for a given change in interest rates. So we'll start with a basic example. Here we're looking at a 10-year option-free fixed-rate bond, 6% coupon, that was issued at par, a duration of 7.4 years. For calculation simplicity in this first example, we'll assume only annual pay, although in practice, most bonds are going to be semi-annual pay. So if we were to estimate the price change for 100 basis points yield shift using this duration metric alone, you would arrive at a 7.4% price move, either a price appreciation for rates falling by 100 basis points, or prices going down if rates rose by 100 basis points. And that's simply taking the 100 basis points, or 1%, times your 7.4-year duration, to estimate the price change. So I use the word estimate because duration can be a helpful metric for a rough approximation for a shift in interest rates. However, as we'll see in part 2 of this example, this is a non-precise estimate. Well, the reason why it's a non-precise estimate is we'll see if you have your financial calculator with you and you simply plug in the price output or the present value output for a 10-year fixed rate bond with a 6% coupon issued at par, you'll notice that if rates immediately shift upward by 100 basis points, the new price is $929.76. That's a 7.0% price decline, not a 7.4% price decline. Well, same financial calculator, and instead you're assuming yields shift lower by 100 basis points. So instead of the 6% yield and 6% coupon at a par issuance, you've immediately got a 5% yielding security with a 6% coupon that will now be at a premium to par, and the present value you'll find is going to be 1077.22. That is a 7.8% price increase. So why did the price decrease less than the price increase for the same absolute shift in yields? Well, the answer is for option-free bonds, they will exhibit what's known as positive convexity. And that is the whole idea behind convexity. Convexity measures the asymmetry, either positive or negative, for price fluctuations for a given change in yields. Bonds with positive convexity mean that for a given absolute shift in yields, prices rise more for a given rate decrease, then they fall from that same absolute rate increase. That's known as positive convexity. Negative convexity bonds have the opposite. The asymmetry is to the negative, and we'll see why that is in a minute. Here are some of the formulas related to duration and convexity, and I won't go through all these in great detail because I want to make sure that we focus on the concepts of duration and convexity and what they represent and inferences for bond portfolio management. I'll keep these up here for you to digest, and then we'll move into some examples and scenarios to illustrate each of these concepts and calculations. Here we have a duration calculation for a bond with the following characteristics. In this example, we have a semi-annual pay bond with a 9% coupon, a 10% yield to maturity. So we know that the yield is higher than the coupon, so the bond is going to be at a discount to par. And we're looking at a 50 basis point change in yield. So the way that you would calculate duration in this example is you're going to calculate the price of the bond at a 10.5% yield, the price of a bond in a 9.5% yield, so the higher price at a 9.5% yield versus 10, the lower price at a 10.5% yield compared to 10, and take an average of that price change when estimating duration. Since it's 50 basis points instead of 100, you're going to multiply that number by 2, but it's going to be an average of the up and down price move, as we'll see in the solution in a minute, that's going to get you your duration number. So you can see down here, you're looking at the present value of the bonds price at a 9.5% yield. That's going to be 97.75. Present value at a 10.5% yield, 93.45. Then we're going to take an average of these changes, and again, we're going to multiply that by 2 because it's 50 basis points, and we're going to get to 4.51 is going to be your duration. Now, what we'll remember is that duration, again, is underestimating the price change higher and overestimating the price change lower for a given change in interest rates because it's not factoring in the convexity element of the positive asymmetry for an option-free bond. Now, we're going to calculate the price change for a 30-year 6% semi-annual pay bond. It's currently trading at a 7% yield, and yields are going to increase by 50 basis points. So we know that this bond is going to be at a discount because the coupon level is less than the yield, and the bond price is going to fall further given that rates are going to be rising another half a point or 50 basis points. And for this calculation, what you're going to do is you're going to find the price of that 30-year 6% semi-annual pay bond at a 7% yield. You're going to then take that yield to 7.5% and compare those two prices. So here we see for a 50 basis point increase, that new price is $821.97. To calculate the modified duration, you're going to look at the price being lower by 50 basis points, which is 934.37, and then the lower price at a higher yield. In this case, it's also 50 basis points, so we're going to multiply that average by 2 to get to a 12.84 year duration. Now, we are going to then estimate the impact of convexity. So again, for this option-free bond, the 50 basis point increase will lower prices less than prices rise with the 50 basis point decrease. That convexity is what's going to be the difference between the duration alone as an estimate and the true value of the bond. So if you want to see this play out from a calculation standpoint, simply go to your calculator and change the present value based on a higher and lower yield of 50 basis points. What you're going to find is that there's positive asymmetry to the price move higher with lower rates than the downside move with higher rates. And we saw that in the example several slides ago. And the mathematical formula for looking at that is down here. And here is your convexity adjustment. You can see that formula play out in our solution right over here, and that is simply the adjustment to duration that accounts for this positive convexity for an option-free bond. You plug that in to get your change in the bond price. Here's your duration adjustment. Here's your convexity adjustment, and you'll find that for a 50 basis point increase in rates, the bond price is going to fall by negative 6.1%. Notice how that is a lower amount than implied by duration. If we had simply used duration as an approximation, we would say for a 100 basis points move, bond prices are going to fall by 12.84%, which means that for a 50 basis points move using duration alone, the bond's price should fall by roughly 6.4%. But as we can see, that's not what happened. The bond price fell by 6.09%. That 31 basis points of difference, that idea is positive convexity. If we would have looked at the other way, if we would have looked at a 50 basis points higher, or I should say a 50 basis points of lower yields, the price would have risen by more than 6.4% because of positive convexity as well. Now we're going to be looking at calculating money duration. In this example, we're looking at an interest rate increase of 100 basis points, and we're looking at the red bond. So we've got a modified duration of 6.78. We have a price of 102.7, which means that your money duration is going to be 6.78 6.96. And that, again, is simply taking your modified duration of 6.78 and multiplying that by the full price of the bond, which is 102.70. So now we'll take a look at some takeaways related to duration and convexity. So some rules to keep in mind is rates go up, bond prices fall. There's an inverse relationship between interest rates and bonds prices. Duration as a concept is an approximation or an estimate for a bond price's sensitivity to changes in interest rates. So for example, a duration of 5 years implies that for 100 basis points higher or lower, bond prices should move by roughly 5% up or down with that inverse correlation. Convexity is a second derivative for the pricing relationship between interest rates and bonds. This adjusts the duration number for precision to precisely estimate a bond's price change, either up or down, and measures the extent of the positive or negative convexity and asymmetry with respect to bond price moves. High convexity bonds lose less and gain more when rates move. That's the key concept here. For bonds with the highest level of positive convexity, they have the most positive asymmetry. For option-free bonds, they will always exhibit positive convexity. For bonds with embedded options, it depends on what type of options are embedded in the bond. For a bond with a callable option, like a mortgage-backed security, where the underlying homeowners can redeem can pay down the mortgage at par, or for a callable corporate bond, for example, where the corporate issuer can redeem the bond often at par. In this scenario, there is negative convexity for that bond at a certain point. As bond prices, as yields fall and bond prices approach that call price, then they have negative asymmetry or negative convexity, meaning that bond prices rise less or perhaps not at all at a certain point above that call price, then they fall if yields rise. This is because of the value of that option embedded in a bond. So remember, for bonds with call options, which is the right to redeem that bond at the issuer's options, as rates fall below a certain point, bonds start to exhibit negative convexity as bond prices appreciate up to and at that call. From a real-world application standpoint, portfolio managers use both duration and convexity to estimate bond price moves for changes in not only parallel shifts in the yield curve, but shifts at various key rates along the curve. It allows bond managers to factor in embedded options when estimating the risk profile for the bonds that they hold. Traders adjust hedge ratios to account for convexity bias existing within their bond portfolios. And central bankers, for example, and researchers use convexity as a means of explaining why bond portfolio asymmetry exists, particularly for bonds with longer durations, higher convexities, and bonds with negative asymmetry, given the optionality embedded in certain types of bonds with call options. So that wraps up our deep dive on duration versus convexity, a key point within the fixed income curriculum, and one that is likely to be tested potentially in multiple forms on exam day. So with that, I'll see you next time. Thank you.